Hi everyone, this is Finance Meets Real Estate. So I meet here every Tuesday, 6:30 p.m. Eastern Time. We have incredible guests every week. Make sure to check us on YouTube as well, Finance Meets Real Estate on YouTube. Today we're having my friend George Roberts from Horizon Multifamily, who's going to discuss the macroeconomic situation around real estate. And he's going to discuss how he approaches multifamily investing as a data scientist as well. So George, he holds a he holds a PhD in. Remind me exactly the subject, George. Is it like biomedical science or?
Oh yeah, immunology and microbiology. My research was in.
Okay.
It was really a matter of genomics more than anything.
I see. Interesting. Okay, and so so you've been involved in like scientific research publications, and so you're a recipient of also Transforming Data with Intelligence Award. And okay, so on the investing side, so you have or real estate side, you have an upscale residential construction company in Michigan, right? And you are also principal of Horizon Multifamily, which sponsors value-add multifamily opportunities in the Southeast for qualified investors. You're a general partner and co-general partner in a few projects. And you're host of The Foundry, which is a podcast. Make sure to check George's podcast, The Foundry. It's a great one as well. So with that, I'm going to pass it on to George. So it's an interesting discussion today around the macroeconomic environment through housing and economic data, and basically how he approaches multifamily investing. I'm very curious myself. If you guys have any questions, feel free to put them on the chat or just speak up. And we're going to open up for a bigger Q&A at the end as well.
All right. Well, it looks like my webcam just decided to choose this moment to go out, but never mind. We'll be looking at my slides most of the time today. Oh. Uh-oh. Looks like I have a YouTube video open here.
Well, at least on my end, I see just like an article or like, so maybe that looks okay.
It's really a great story, by the way. All right. Well, that was great books in 10 minutes. All right, great books in 10 minutes. Oops. Oh, give me a break. All right.
I'm going to share our YouTube in the meantime.
Okay. Hope you do a little editing here. My mistake.
No worries.
Let's get back to it. Okay, here's our PowerPoint. Yeah, I don't think you're seeing the same thing as me here. I didn't share the entire screen, so let me stop this. We'll start over.
No worries.
All right.
I did see
a slide. I see. Here we go.
George, I did see a slide, the presentation slide, so that seemed to be okay, but not sure. Yeah.
Okay, I see. It's not lighting up. Do you see the big version or do you see the preview?
Well, I see investing in uncertain times, and then the quote. From,
all right, good. All right, so here, this is our quote. Oh, thank you, Charles. Looks like we've got the big version. Thank you. Very valuable. feedback there. So investing in uncertain times. So here's our favorite warrior philosopher, Sun Tzu, who reminds us that in the midst of chaos, there is opportunity. So what I'm going to try to do here today is help you to be forearmed with knowledge so that you can help to make your best next move. All right. So where's multifamily real estate headed? We're probably most interested in how things look in the United States, but we'll also take a comparative look around the world. So we are here on the cusp of an officially declared recession. Many participants, I think, are expecting carnage a la 2008. I don't think that's going to happen. I think the people who are waiting on the sidelines are wrong. I want to compare how the current situation compares to 2008, and I'll actually lay it on the line here. I'm not expecting a crash within the next 5 years, although we may see, some degree of shakeout. And the reason for that is that I don't think that with the amount of undersupply that we currently have, that we're going to see extraordinary price drops. So there's no reason that we should have to limit ourselves to the United States. It's a great real estate market. I'm loving it. I'm making a lot of money. I hope that you in the audience are as well. But you have the opportunity here to look at many other examples, and I think we should do that. There are many other countries that I think are in worse shape than the United States, and that if we are going to see issues, we'll probably see there first before we'll see in the US. So Canada, I think, is just such a country. They had no major correction in 2008. Now, I think a lot of people think that Canada is very much like the United States, and maybe so, English speaking, listen to the same music. But again, it's a very different financial system. Their last correction was in the 1990s. They've been printing money like crazy, just like we have. And if you look at the top 3 least affordable cities in North America, they are all in Canada: Vancouver, Toronto, and Hamilton. A very large proportion of income goes to servicing mortgages. And they also have different types of mortgages in Canada. Whereas in the United States, you can get a 30-year fixed mortgage. You're going to have to refinance in Canada every 5 years. So as rates go up, and they are going up like crazy in Canada, we're going to see, I think, a lot of problems. And in fact, this just in: Canada home prices post record monthly decline in August. Now, let's be clear, this is a 2.4% decline, but this is frightening. That's a monthly decline. I think it's something to keep our eyes on. And I think with this, I don't want to belabor the points. We just make some comparisons to the US. So whereas in Canada, you can get a 25-year mortgage and you have to refinance every 5 years. After that, it's adjustable. In the US, you can get 30-year non-recourse mortgages with no prepayment penalty. So I think we have a very, I would say, consumer-friendly system here in the United States. We go a little further. There are countries that have 60 or even 100-year mortgages, countries that have mainly interest-only mortgages, but I think we want to kind of move on. All right, what about Australia? So this is one of the wealthiest countries in the world. Part of that is their housing market. Their housing prices are just crazy, off the charts, expensive. And it's been said that an entire generation is having a hard time simply buying a home. So many reasons for this. The population in Australia is exploding. Supply is not keeping up, and they have a very onerous approval process, making it hard for the supply to keep up. China is another one to keep an eye on. We have apartments that have no hookups for either water or electricity. You essentially can't live there. You have a lot of poor workmanship. You see somebody inspecting a recently constructed apartment, and the concrete, if you can call it that, is just coming apart. In the lower right, you have some balconies, an newly constructed apartment that have collapsed. So I think we're going to see a lot going on in China. You've all heard about Evergrande and their financial woes. A lot going on in China. All right, so now let's come back to the United States. Let's take a look at some key parameters to compare 2008 and 2022. Housing supply was clearly oversupplied in 2008. Currently, we're suffering from undersupply. Home equity, as we'll see in a few minutes, was low in 2008. It's high in 2022. The increase in the monetary supply was significant in 2008, but extraordinary over the last couple of years. And we are now facing high inflation. All right, now let's take a look at housing prices and what might be considered sustainable. So during ordinary times, you might see maybe 4 or 5 times the house price to median income ratio. This was significantly violated during the Great Recession and had not been violated since the 1950s. Huge boom there, a lot of household formation, took a long time to catch up. And now, boom, we're sweeping right past that bubble territory. But does this mean that the prices are going to crash tomorrow or in a week or next year? I'm going to say not yet. I think we need to see a little bit of supply, and we'll examine that in the next slide. Okay. When you go out and ask questions to the internet, of course, the internet knows all, right? How many housing units are we undersupplied in the United States? You'll get different answers. If you look at household formation, some people are saying maybe 5 million. But we also know that we have low household formation during recessions. We just suffered a major recession. Also, we know that the younger generation hasn't really been getting out and buying homes as much as they have in the past. And that can also be impacting the statistics. If you look over the past, say, since the 60s up until the crash, we need about 1.5, maybe 1.4 million units constructed each year. However, since the crash, since we dip below that line, we have about 8 million missing units. And as you'll see in a moment, we're really not catching up. It's going to take a long time to catch up. So here's our warrior philosopher here to remind us that this looks very frightening, but it could be opportunity. Let's take a look at some more statistics, again, released just this morning from the Census Bureau. The residential construction report shows that over the last, I think it's been, 1, 2, 3, 4 months at least, we're seeing these leading indicators of permits and starts returning to around 1.5 million. So I don't see us overbuilding anytime soon, even if we stayed at, say, 2 million, okay? Say 2 million permits and starts, eventually our completions will tend to reach up towards 2 million, but it would still take us many, many years to catch up. So again, here's our philosopher warlords, saying, "Oh, holy backlog! Look at this. We're not working through the backlog. It's going to take a long time." When you take a look in terms of housing starts per 1,000 households, again, our population is growing, and for many reasons, including immigration. Right? We've got a lot of people coming, and we're not building the houses faster. Certainly not faster than we have in the past. In fact, significantly less if you look in terms of households. So here's maybe a little bit of a contradictory opinion here. You can see that the inventory of builders' homes that are either present, completed, or in construction is increasing significantly recently. And this is Lawrence Yun. He's the chief economist at the National Association of Realtors. Again, here, I'm not just here to show you one side of the story. We want to take as full of a look as we can. Now, take a look at what's happened since 2020. Well, here, let's first of all take a step back to the Great Recession and the housing crash. As you can see, the number of units produced each year, actually, this is, as I remember, this is starts, has declined precipitously. And although we've seen some improvement since 2020, most of that increase has come in multifamily. It makes a lot of sense. We're a renter nation now. We've gone from a sort of an ownership society to a renter nation. And it makes sense that if you want to construct units quickly, it's going to have to be apartments. So a lot of the increase we have seen lately has been multifamily units. Okay, now let's take a look at home equity. One of the problems we had last time around was that people had been using their homes like ATMs. home equity declines for two reasons. First of all, you have a lot of cash out mortgages, and then you have home price declines. This is looking at absolute dollar value. A lot of problems with this, including that it's not normalized for inflation. So what I've done here is I've taken some Fred statistics and I've taken the owner's equity and I've divided that by the market value. And you can see that, in the past, people had different views towards savings. You'd see people have mortgage parties. For the younger folks, what happened is people pay off their mortgage and they invite everybody over, right? They might go burn their mortgage docs. Hooray, we own it free and clear. But people don't really do that anymore. And I guess with the lower rates, in some ways, perhaps it doesn't make as much sense to go and pay that mortgage off. But again, you can see that, again, there's a huge decline in home equity as a percentage of total value. And that is a trend that has continued until, sort of recently. We are recovering a bit. Now, some of that, of course, is due to home prices. Okay, so if you take a look at the S&P Case-Shiller home price index, you can see home prices are declining here, but they're also, the equity is declining faster. So, a lot of things going on. There's the cash out. You also have foreclosures, people just like literally, going to zero. And here you can see home prices are increasing very rapidly, but we're not really increasing quite as rapidly here in terms of the equity as a percent of the total value. So again, the cash out mortgages are coming back, maybe not as much of a problem as last time. Again, we are recovered. But the important thing to remember is we're doing better than we were last time around. Hopefully this holds out and you don't see a lot of people underwater. Obviously, a lot easier to be underwater if you're leveraged to the hilt. Okay, now here's a reminder that equity in homes, like everything else in real estate, is local. Here we're just looking at the state level, and you have some very equity-rich areas here in yellow, have a heat map, and less equity-rich areas here in lighter blue. Some of these areas, of course, again, much of this is driven by home price appreciation. And areas where you've seen high home price appreciation, like Idaho and Florida, are seeing a lot more equity. And some of this may be dangerous. Again, there is some very, very rapid price appreciation in certain areas. So I guess we'll bring back our philosopher warlord here to remind us that never forget that real estate is hyper local. So again, you're going to want to look at your local markets, definitely want to go below the state level. This is just taking a look from the very, very highest level. Okay, now here's a reminder that inflation does impact mortgage rates. When you look at that 30-year fixed mortgage rate and you look at the consumer price index, it doesn't really make sense to lend money out if inflation is higher than the rate of interest that you're collecting, because essentially you're paying people to borrow money from you. And as you see in the late 70s, we never got far ahead of the CPI. I'm sorry, or the CPI never got far ahead of the 30-year fixed, but now it's happening. So what's going on over here? Well, a lot of things. I mean, some of this could be maybe some government intervention. Could be that people think inflation is transitory. I'm telling you that it can't last forever. Okay, either what's going to happen is the mortgage rates have to go up or inflation has to come down. And I don't see inflation coming down anytime soon. These mortgage rates are most likely in the short term going up. Now, how far the Fed can go in fighting inflation is an open question. We have a national debt that is, it's difficult to say how the US is going to continue to make debt service payments if interest rates go up too much higher. So they may blink when our economy takes a slide, and maybe we will see that that rates do come back down. All right. Yeah, here's an interesting thing I found, a news item recently. Cities seeing the most price cuts for homes. So this is the percentage of homes that are seeing a price drop from the listing price. No surprise here. You've been following Stefan, Boise, Idaho, topping the list. So again, I don't see necessarily that our entire real estate market is headed for a major slide. But again, real estate is hyper local, and you're going to see certain areas are going to react very differently than others. All right. So I took a look a couple months ago. I saw some really frightening news, some scare statistics. Some people were taking a look at the average sales price for houses sold in the United States, and they were showing only the blue line here. Now, remember, new houses sold each month are going to differ from the houses sold last month. The houses that are demanded in a particular month could be nicer or perhaps nice. They could be larger, they could be smaller. Certain areas that have higher home prices could be transacting at a higher rate than other areas. Building rates could differ. So the first question I asked is, well, frightening that we're seeing such a drop. Literally put us back 11 months in terms of home price appreciation. Again, this is the blue line, just looking at new houses sold in the United States. So I put the S&P Case-Shiller U.S. National Home Price Index here in red and saw that the story was, I think, a bit less scary. So the reason that we should be interested in Case-Shiller, as I mentioned, new homes, they differ. It's like apples and oranges. So I'll bring back our warrior philosopher to remind us that the Case-Shiller provides an apples to apples comparison because these are homes that are previously sold. We're not looking at new homes here, and you could say that that might be perhaps a weakness of the statistic, but its strength is that if you look at a home that's been sold before, now look, some of them are going to fall into disrepair, some of them are going to be improved by flippers, but on average, you're looking at least the same chunk of land and the same square footage. So what I've done is I've continued to update this, and you see we're seeing a major around here in July for the average sales price for new houses sold in the United States. So I'm not surprised by this. I certainly don't expect that line to continue down, especially when Case-Shiller is here continuing to rise or at least leveling off. Now, again, this could be a distant early warning signal. But again, I don't think that this is telling us that the sky is falling. Not yet. Now, let's take a little bit of a wider view. I'll show you what's been happening since 2000. So you can see these two generally sort of track each other, and it depends on the scales. Okay, you can play with the scales a little bit, but regardless the scale you pick, you can see that you can certainly overlay the two, which makes sense. So I think the next few months, what I want to do is continue to watch this. Again, the average sales price for new houses sold in the United States could be the canary in the coal mine, but again, I don't think we're quite there yet. All right, so what are some of the things that determine, I think most of your listeners here, your viewers, are interested in commercial real estate, or at least cash flowing rental real estate. What we want to see is if wage growth is keeping pace with rents. So if wage inflation continues to exist as rent inflation continues, it's entirely likely that we can continue to charge higher and higher rents, and perhaps we'll continue to see higher and higher valuations in the commercial space. And it does look largely like this is the case. But you have to remember that there are many different people out in the economy these days, and we have wage earners, but we also have hourly workers. So the best I could do using Fred statistics was take wages and salary here in blue. You could think that's the whole pie. And if you just take out the hourly wages, and I show this here in gray, you can see that I don't know that we've all kept up. Perhaps if you have a C-class property, I know you probably had a hard time during the recession, may have. Maybe there are hard times ahead because you may not be able to raise the rents quite as much. In terms of percentage increases, people on hourly wages are increasing at a slower rate. And it's also important to remember, and I don't think I have a slide for this, but people in A-class properties spend a smaller proportion of their income on rent, perhaps not surprising. they're making a ton of money. They don't need to spend as much on housing. People a little bit lower on the economic spectrum, they're getting a lot closer to that 1/3 metric that a lot of property managers want to see. They want to make sure that you're not spending more than 1/3 of your income on housing. Otherwise, it's highly likely that you are going to be unable to pay the rents. So again, could be indicating some differential troubles depending on what sort of class of properties you're investing in. Or it could be the time to do a great rehab and reposition as a B class. Okay, so I did mention briefly that it looks like we're on the cusp of recession. The July jobs report was very interesting. Economists are not declaring a recession yet, even though we had 2 quarters of consecutive negative growth. One of the reasons is that apparently we have a strong job market. And July's job market report seemed to be particularly controversial. Well, somebody broke it down, and I want to say, is this from Zero Hedge? I'm missing my notes here, but it'll probably come to me. The point is that we saw a decrease in the number of full-time workers. We saw a decrease in the number of part-time workers. These are part-time and full-time workers holding a single job, but multiple job holders apparently accounts for the increase that we saw in employment. Now, those of you who are following labor force participation know that we have a much more powerful statistic to tell us how many people are pulling and how many people are in the wagon. And I would highly recommend take a look at labor force participation. And what you'll see is that every time we have a recession, whether it's 2008 or whether it's the coronavirus, we are seeing a large number of individuals leaving the workforce, and we never do get to the same levels of labor force participation that we did as of the last peak. Now, some of this, of course, is due to the fact that we have an aging population. We certainly need to take that into account. But again, we also need to remember that, how strong our economy is largely determined, again, by the number of people pulling. So we can't all be in the wagon, as they say. Okay, now let's take a quick look at inflation cycles. This comes to us from Bain Capital. And what they have concluded is looking at the last several recessions, starting in 1958, the median is around 30 months, okay? And let's see, what are we currently into this thing? About, I want to say, March 2021, maybe about halfway there. But I don't believe that what we're looking at here is an ordinary inflation cycle. As I mentioned earlier, we have a huge national debt, okay? We can hardly service the debts as it is. If interest rates go up significantly, and they will by definition, if the Fed hikes rates, we're going to see those treasuries are going to become much more onerous to hold. We're going to see that we're spending a significantly larger chunk of our national budgets simply to service the debt. I mean, there's many things that could happen. We can monetize the debt. Well, that's going to cause further inflation. So will the Fed be able to fight like Paul Volcker fought in the late 80s, late 70s, the early 80s? I don't think so. I mean, he was about, 6'5", cigar chomping, mythical Fed head. This Jerome Powell is no Paul Volcker. And again, I don't think that even if he was, all kidding aside, I don't think he has as many bullets or as many arrows in the quiver as Paul Volcker had. People wanted to see an end to inflation in the late 1970s, and they were willing to put up with a lot. I know that Volcker got a letter from one of the people who said, hey, I lost my job in the recession caused by those high rates, but I understand what you're doing. If you didn't do it, my savings would have been completely wiped out. So I don't know that we're quite there yet that people would support that sort of inflation fighting. So I'm going to say I think that we're going to be at this for quite a while. And if the inflation is high, well, then we're going to see rates are going to rise. And that has a real impact on prices in the end. All right, so let's take a quick look at the increase in the 30-year fixed rate mortgage. And again, I think most of you are probably interested more in commercial, but I think it's very important to take a look at residential real estate because you're going to find a lot more data, and that data is going to be very, very valuable. If you look at real estate or economics in general as being the study of finite resources with alternative uses, again, you can live in a single family home, you can live in an apartment, you can rent, you can buy. These are all alternative uses of real estate or alternative types of real estate. What happens in one bucket will, without question, impact the other buckets. So you can see that the increase, and again, this is all biased as to when the year starts and what was going on, but you can see that here in 2022, perhaps not the greatest increases in mortgage rates, potentially yet. But even if you compare to, say, 1981, we got a little bit ahead of that. But wow, look at the end of the year. Look at how quickly we see things increasing. So probably most exciting to take a look at this chronologically. You start here in pink or magenta here, 1979. Towards the end of the year, you see that inflation fighting starting to kick in. 1980, a little bit of a reprieve. You got to expect some reversals like that. And then really picking up from where it left off in 1980, 1981, seeing great increases. And then by 1982, already seeing declines in the mortgage rate. So we don't know, again, how long this is going to take. It depends on how much spirit the Fed has. They could be fighting for another, year or 2 or 3. But again, at some point, rates will come down. What goes up must come down. Okay, here another scare statistic. Housing affordability creators. Remember, housing, this is something that people finance. People do not tend to buy their homes with cash. And we have to look at the marginal buyer in the market. Sure, there are going to be some investors buying with cash, but most people are going to finance. And so as the rates go up, housing affordability is going to decline in a major way. But again, remember, in 2007, prices could drop because we had oversupply. Now we have people fighting for homes. We still have a seller's market to some degree. And here, already old statistics. Every Thursday, you're going to see a new statistic come out from Freddie Mac. And this is showing that although we did see a little bit of a reprieve from mortgage rates as we head from the middle of the summer towards the fall, now they're back up. We're already back to another local maximum. So watch out. Again, what you see in the residential market is going to spill over. It is going to impact commercial as well. And oh yeah, I believe I showed you that earlier. But again, here is our philosopher king, philosopher warrior, to remind us again that in the midst of chaos, there is opportunity. So again, what I want you to do is digest as much macroeconomics as you can. Remember, of course, the pundits are wrong just about as often as they're right, but you want to give yourself an edge. Definitely you want to understand as much about the economy as you can. Again, look for those canaries in the coal mine like Canada, already seeing dropping home prices. And hopefully you can be armed with a full armor of economics, whatever that's worth. So I think that this is, oh, here we go. Actually, I've got a couple more for you. I think this is really more like overtime. If you want to go through some additional slides here. Yeah, so monthly mortgage payments at the time of purchase. Wow, just look at that go up. The rates going up has a huge and incredible impact. If I remember correctly, I want to say going from like say 3% to 9%, essentially doubles the monthly payments. Monthly payment as a percentage of income. And some people would say, hey, wait a second, this is 25%. That's not too crazy. We're not up to 30%. Hey, we can still handle some further increases. Well, we may have to with the undersupply. This may go way out of joint, and we may see people paying up to 40% of their income. as things bake. And again, just a reminder that over the long term, Federal Reserve rate hikes and the mortgage rates, they do tend to more or less move in tandem. So again, it's not free. Fed fights inflation, it's going to get a lot more expensive to buy a home. So I think this might be a great place to stop. And I do apologize. I think I did sort of race through, but the good news is if you have questions, we can really go at it. I've got additional slides. And actually, I've got another treat for you if you wanted to talk about cap rates. We can get into a little discussion of that, but I'll just open it back up, close the slide share so I can see the faces. So congratulations, whoever's still on after 40 minutes of macroeconomics, you are the survivors.
Mhm. Thanks, George. So a lot of interesting slides and charts there. I do have questions, but I do want to open it to others first. You guys have some questions for George? Okay, maybe let me give it a start actually. So do you want to actually, because I know you mentioned you went to show the cap rates kind of slide. Do you want to show us that one as well? I'm curious.
Sure. Oh, it looks like I actually had that on a different computer, but just starting to do some calculations. I'll put out a YouTube on this shortly, but I don't know that everybody really considers the impact of interest rates and cap rates.
Mm-hmm.
So when you have rising interest rates, one of the things that happens is it's going to impact your debt service coverage ratio. And currently, Fannie is going to require you to have at least a 1.25x debt service coverage ratio. Now, they may also let you go up to 80% loan to value, but that isn't going to happen if you have these lower cap rates. So I was calculating earlier today around 6%, you're going to be capped out at around 7.2 cap rates. But if they go up to 7%, then you're going to be capped out even around closer to an 8% cap rate. So most people are not buying in markets that have 7 or 8% cap rates. There are a lot of problems that you're going to and refinance is just one. And then you can say, well, hey, I'm going to sell it. But if everybody decides, well, I can't get my cash out from refinance, I'm going to sell, that's not going to happen. Right? Too much supply is going to bring the prices down. Again, there's no such thing as a free lunch. So I've heard a lot of gurus say for a long time, oh, cap rates don't really matter. Hey, if I have a 5% cap rate versus a 10% cap rate, every dollar that I raise the NOI of, I'm going to get $20 in value. But I think you really need to think more in terms of proportion, right? If you're going to double your NOI, you're going to double your value at, either way. So again, I think that the low cap rates are dangerous. They're getting more and more dangerous by the day. And I really think that people need to rethink some of their strategies. These cap rates are going up, whether you like it or not. Only question is whether rents go up faster and allow the prices to remain at least stable.
Mm-hmm. Yeah, that notion of sort of like how much like an extra dollar in NOI effect translates in property value at the lower cap rate is a strange one, because it's like it sort of stimulates, let's overpay for a property or something to be at the lower cap rate. I don't think that's how it works. Right. I think it's sort of like a false reasoning there. But I agree. And so what about the rent? So your thesis on interest rates and cap rates then being sort of there's a dependency of debt service coverage. Is that kind of what your suggestion is? Or like, do you expect?
Yeah, exactly. Yeah, I would say just map it out. I mean, make sure that you can handle all of the requirements of the loan in your modeling so that you're not planning on some mythical refinance that can't happen. Mm-hmm. And but I think we got one from Edwards here. Was it Edwards? Not sure the first name. So yeah, if cap rates go down or if they go up, I'm sorry, I think the question, what Scott Edwards there. If cap rates go up, bad for sellers, but good for buyers. Yes, I agree. I mean, if you were going to just buy, better to buy at a high cap rate, all things equal. Now, what does a high cap rate mean? It means that the market thinks that it's dangerous. And the market is generally never 100% wrong. There's usually some wisdom there. So I'd rather have a higher unlevered rate of return. Essentially, that's what your cap rate is. I'd rather have a higher unlevered rate of return. I mean, how are you going to benefit from one of the greatest reasons to invest in real estate in the first place, which is that you can leverage, and you can leverage up to about 80% of your purchase generally. Well, as interest rates go up, you don't want to be negatively levered. That doesn't make any sense. So again, whether you look at it from each dollar I put in at a higher cap rate is going to give me more cash flow, to the fact that we see reversion to the mean, and starting at a higher cap rates, probably better off than these historically low cap rates. Seems that they can only go up.
Hmm. But so basically, is your expectation, let's say with your kind of general expectation, if inflation persists for longer, let's say, so it has 30 months median historically for inflation, for an inflation cycle, let's say roughly halfway, but kind of you had an argument for maybe it could even take longer potentially, right? Let's say we don't know precisely, right, or in any way. But in terms of, is your expectation if you could get higher interest rates to get an increase in cap rates? Let's say in your understanding, the thing that you were looking at in terms of like also from the perspective of debt service coverage and so forth.
Yeah, exactly. I'd say in general, you're probably better off with higher cap rates now, but there's a lot that's wrapped up in that. I mean, Class C properties have higher cap rates, but we also see a historically low spread between Class A and Class C. There could be another reversion to the mean that has to happen there as well. So I alluded to maybe, hey, it's not a bad time to do a heavy reposition in principle, but well, that takes capital. Most of that comes generally from debt. When you have a bridge in a rapidly rising interest rate environment, that's danger. So one of the things I like now is seller financing. You can get seller financing with relatively few covenants. They're not going to look at things like your occupancy. You can do things with seller financing that you could only do with a bridge, and you get the right seller financing. It can be pretty sweet. I got a deal closed last November, 3.5% seller financing, 5 years fixed. You're not going to find that in the market.
Right. But in terms of just like to get back to the cap rates question, do you think that, because my understanding is like with having, while we still have significant rent growth, and let's get to that slide actually where we're seeing some of that slowing down, right, and coming down a bit in terms of rent growth. But while we're seeing the significant rent growth, that's putting downward pressure on cap rates, even in the formulaic theoretical sense of for how cap rates work. So we have interest rates. The interest rates are the result of the Fed fighting inflation, and that drives cap rates up. But inflation itself is driving rent growth, which is driving NOI growth, which is driving cap rates down. And so there is an offsetting effect. So I'm not so certain myself of cap rates rising from the interest rates part in the current inflationary environment in that sense, because we just get like so much rent growth. But whenever we perhaps like we can get to your slide with some of that reducing, and perhaps as inflation starts to reduce, then that may be the case if interest rates linger longer and so forth.
Right. Well, just to start from an empirical approach, in the 1970s, you can take a look at rent increases and the values of, inflation rate. So inflation rate and rent increases basically kept pace, very heterogeneous. Sometimes you see that the two don't have a very high correlation, but over the long term, you were basically covered. So if you bought right in the 1970s, you did well because your money may be worth less at the end, but you're collecting more of it. So what I would see is really driving the increase in cap rates is negative leverage. At some points, if the interest rates are rising above the cap rate, what that's really telling you is that you're paying money to take on that loan. I mean, you could argue also inflation is having an impact, but it doesn't really make sense to be negatively leveraged.
Right, right. But it could adjust to to your point, but that could adjust with sort of reducing the loan to value ratios. And since you've got the high rent growth, you still don't have cap rates increase. It's just been
Right.
what I've been thinking. I might be wrong. I don't know. I'm
Yeah,
not.
well, exactly. Well, exactly. You got to remember, ceteris paribus, cap rates increase, then that means the values are decreasing.
Yeah,
But
exactly. Kind of don't.
ceteris paribus doesn't explain the real world, right? So we
Okay.
have this inflationary environment, and the numerator is increasing, and the denominator is increasing too. And you know, who wins? I'm going to guess that an inflationary environment, that's we're probably going to do okay. You have to define okay, right? You can do at least three things with money, right? You can invest in real estate, you can invest in the stock market, or you could bury it in your backyard. So you know, as long as you're doing significantly better in real estate than the other two options, I would say we're doing pretty well.
Mhm. So in terms of, so can we get to some of the slides actually, George? I want to ask you some
Yeah,
questions.
sure. Okay.
There
Let
is
me see
some
if
really
I
good
can share it
information
again.
there that some of it is new, at least for me, I'm sure for others as well. And so,
Oh, I don't think this is the big version here. Where is it? Here it is. Ta-da. Ah, okay. All right. How far back do you want to go? You were looking at the
let's look at the
wage
rent growth.
increase.
Do you want to look at the rent growth, like some of the rent growth reducing in a few cities, I guess, something like that.
Oh, yeah. I know which one I think you're talking about here.
Mhm.
The asking price declines. Yeah, look at that.
Yeah.
Over half.
That
Cuts
I
in
saw,
asking
like,
prices.
percentage of the homes that saw like reduction in asking prices, right? That's what it is,
Yeah.
basically. Yeah, that one is interesting. Yeah, that one seems to be appears correlated to overvaluation indeed, quite a bit. Because like
Yeah, exactly. So I imagine most of you are following Stefan's work naturally because you're here
like,
today.
yeah, I don't know.
But it correlates very well. Boise, Idaho, Tampa, Florida. I mean, these are some really super hot markets.
Right.
I do invest in Orlando, which is very hot, but I decided Tampa is a little too hot to touch.
Well, they've got Indianapolis, which is not that high in that list, but it's
Right.
it's gotten higher though, to an extent. So that's interesting. That's quite interesting. And so if you want to get to the Canada, like where you had like the Canada slide, so they're seeing 2.4% monthly reduction. That's like year over year, so to say, or is it just, or is it month over month?
Yeah, this is just month over month. So
July,
July to August.
Mhm.
So, I mean, on the one hand, yeah, you could annualize that, and that's shocking.
Right.
But at the same time, we don't know what's going to happen the following month. Could be a continuation of a trend, could be, you know.
Mhm. But did you, so have you seen, George, some of the, I've seen charts from like OECD, and also there's also Bloomberg Economics one. I've mentioned that one before in the past, like where they have the Canada, because you showed Australia, and I think you were pretty spot on some of the at-risk foreign countries, right? In terms of like Canada, Australia, and I think those are the two you mentioned for now, right? And so, yes, so there's a slide from OECD that's showing like the so-called scans economies. So Sweden, Canada, Australia, Norway, New Zealand. And so they're, so they're kind of commodity exporters. And so, yeah, and so they cut interest rates during the 2014 to 2016 commodity crunch. And so there was an overvaluation from the higher interest rates. And so that's like what exactly, I think you're very spot on your statement with like interest rates rising in that, potentially like causing, like being like a place to look to for sure. Because they, when US real estate was fairly valued, US real estate came out of a very fairly valued place, right? And Canada was overvalued for a long time. It's been like since 2018, and it kind of stays there. And basically it appears it's been a function of this kind of oil economies and their central banks cutting interest rates too much and overstimulating the real estate markets, the housing markets. That was my understanding based on like OECD and others. So Canada definitely is being like very overvalued for a pretty long time. And yeah, I agree with that assessment. But yeah, so let's get to like some of the things that, let's say, at least are new for me that I personally don't know too well. So if we take, let's say, a look at the rent growth, because you had, and I'm not acquainted too well with China actually at all, because I haven't seen charts on China personally. And you've got a lot of like really great charts here. I also liked like some of the ratio ones that you have under Fred. That's very good. Like your last slide, like where you had rent growth. Okay, yeah, this one. So like the
Did I miss it? I think I went past it actually.
okay, yeah.
Yeah, I remember this is
Oh, yeah, this one, right? Okay, so where is
wait, same colors because that's from real page,
45 or
but
so? Like around 45, slide 45 maybe.
well, that was here it is, this one.
This one.
28.
Okay, this one I haven't seen. Okay, this is interesting actually. So for renters income, so they separate renters incomes specifically, right? That's what that statistic is. And so yes, that's interesting. They're so well in line actually. I'm surprised by that. I didn't know that.
Yeah.
That's quite interesting.
I think everybody feels like they're not getting the wage increases to cover inflation yet. But I think I have some doubt of the official statistics as well.
But then what do you think explains? So that's coming from what source? Because what explains, you think, the discrepancy between like renter incomes here and let's say Bureau of Economic Analysis, income statistics?
Right. Well, I think this is annualized here, right?
Yeah.
Yeah. I mean, it doesn't say it, but it obviously is. This was just month over month. So it might be a valuable refinement to go and see how well this data squares with what RealPage is pulling and try and figure out where they're getting their stuff from as well. I mean, I love their statistics, but always worthwhile to take a look at the methodology.
Right. Yeah. And yeah, these are great slides. And so we have a question actually on the chat from Norman. So can you please talk about your luxury home builder business?
Sure.
I mean, that was in your intro that you're a builder. I agree with you that we won't see a 2008 type crash if you don't have the leverage that you had back then.
Yeah, well, I can tell you a lot about building. I've been in the business now for 6 years. We are building luxury homes. When you have a crunch like this, builders can pick and choose. They can just pick the most profitable projects, and that's what they're doing. This is why people are building homes for rich people right now. I mean, I have a lot of opinions about things we need to do for that. There are some government programs, but probably what would be simplest is to just probably get the government out of the way. We need a less onerous approval process. We need less NIMBYism. We need to get projects. We need to get the shovel in the earth a lot faster. There's an interesting place by my house. It's called the Roundhouse. It's a barbecue, and the man who owns it, he was a builder. He got wiped out in 2008, and he decided he was never going to go back to building. And so he was going to make the most delicious barbecue he could possibly make. He makes great barbecue, by the way. But to me, that's just emblematic of what's going on. We wiped out a generation of builders, and it falls onto the shoulders of a new generation to start building these homes. And I think that's one of the reasons that it's going to take a long time to get back to where we need to be, because again, entire generation wiped out. But I don't know if that really is where he wanted me to go with that. But I love the building business. I think it's the right time to be in it. If you're not too crazy, you're not over leveraged, things go very well. I could just tell you one quick story that I found sort of amusing. You've probably all heard of spec homes. Spec is short for speculative. When the builder builds the home before they've got a buyer, that's called speculation. But when you see such vast changes in commodity prices and labor prices and the ability to finish projects on time, because it's hard to get good labor, in some ways it seems less speculative to actually build a home first, find out how much it costs, see what home prices are, because they have been rising. But again, we've noticed that we are taking on a lot of risk when we take a buyer and we don't know how many months it's going to take to complete the project. Just take a look at those lumber prices over the last 2 years.
Mhm. Right, and I guess so. So Norma is actually adding to this question. So if you're more interested in if you have seen any slowdown in the past few months, contracts canceled, etc., like lower buyer traffic, etc., in the home builder space.
So I'm not actually the one who's out doing the tours and such. My guess is no. Every time I talk to my sister, she's bringing somebody new through the homes. But if you take a look at one of my early slides here, I think it was around like 6 or 7, you can
Right.
see that the leading indicators are way down, right? Those early indicators being way down tells me that builders are getting a whole lot more conservative. They're frightened. And some of that could also be fewer people willing to finance the home, construction loans, etc. But again, wow, something's going on here. I think a lot of people are very, very frightened. Now, as for us, we're not really playing with other people's money. We're self-financing our project. And the only financing we're accepting is from people who get a construction permanent loan.
Mhm.
So
Right. And
different players, right? We're not playing
where-
a very speculative game here, so
Mhm.
we're not frightened at all. But there may be some other builders who are frightened for good reason.
And so George, where you had a slide that is showing okay, new home prices that declined over just July and then kind of rebounded, right? And that's not the
Yeah,
case in the general market, like the broad case, sure, let's say. And so,
exactly.
right. And so I understand. So do you think that on the bigger chart where you had it like more historically, that shows
Yeah.
like bigger bumpiness to the new home prices? What do you think causes that kind of bumpiness in that chart? Is it the whole what you mentioned, like the not apples to apples thing that you think is driving it, or what do you think is the driver there?
Yeah, exactly. Every month, different square footages being sold, different areas having more or less, different things being demanded. So, yeah, I think that's a fair analysis.
Have you seen like one thing I've noticed is like if we take FHFA prices and we take case share and we take let's say zero, and okay, zero that can be understandable, but like the FHFA is significantly smoother in its pricing with less volatility than case share, and which is smoother with less volatility than zero. Is that something you've noticed in like some let's say Fred charts and so forth, and what do you think could be driving that?
Yeah,
It
I
just
think
tends to,
great.
for instance, for
No,
global
go ahead.
financial crisis, FHFA had the milder decline than case share.
Right. I think that'd be something to investigate further. So I have not
Yeah,
been making that comparison directly, but definitely something I'd
sure.
like to take a look at.
Mhm.
Yeah.
Sure,
You see, I've
sure.
made quite a hobby of Fred statistics.
Right. Yeah. And that's great. That's really, really good stuff. And so in terms of what is your sense? I think it's kind of I don't want to say $1 million question, but do you think commercial, because some of the narrative is, do you think commercial multifamily is more or less overvalued than residential right now? Which one you think is more exposed to risk? Because I don't have commercial data myself too well on
Well,
that.
I like the way you asked the question two ways, because
Mhm.
which is more overvalued and which is more exposed to risk? Well, I think that your residential is going to fall first because you
Mhm.
got a different set of buyers. Commercial, you're buying for cash flow generally.
Mhm.
You don't have people who well, when you buy your dream home, you pay what it costs. You pay what you can afford to pay. So I think a lot of those buyers are going to be in a lot of trouble. The problem is that even your more sober uh, participants, landlords who are out for cash flow and who bought right, supposedly, they're going to see price declines when people buying their dream home sort of wake up to the nightmare. So eventually, yeah, you're going to see that the whole residential market, I think at some point, it's going to have to come back in line. So one of two things happens. Either prices decline in a more or less violent fashion over some number of years, or we have to level off for a very long time, right? Probably what shows that I think most
But
reasonably is
mhm.
and we look at countries like Australia. I mean, there are some countries that have some very, very high price to median income ratio, and that have seen those ratios increase very, very rapidly, just like the
Right,
United States.
exactly. And actually Norman mentioned that, added that to the chat. So like basically Canada and Australia having, super high in price income ratios. And they also, like to the point that you made earlier, they more typically use floating rate debt, or let's say adjustable after a few years and so forth,
Right.
versus like the 30-year fix. So that could add to some of the sensitivity from interest rates. Okay, no, go ahead, sorry.
Yeah, 100%. So again, this has to come down. But the question is how long does it take before builders get overly greedy and start building 2.5, or who knows? I don't think we've ever gone above around 2.5, not even quite. I think 2.2, if I'm not mistaken, million homes per year. Let's see. Yeah, 2.3. There you go. Since the 70s, never more than 2.3 million.
So George, so that's actually one other thing that I've been trying to understand better. So when people speak about the housing shortage, so it frequently refers to this underbuilding of new construction homes, kind of this shortage in building, sort of missing units that we ought to have built, like, or something like that, like what this chart is showing. Now, do you think that's the more relevant housing shortage to kind of our expectations of price declines or not, relative to, if you take, for instance, like US Census Bureau, and you take the total population to housing units ratios? Okay, I see that this, in the new construction, we have like significant shortage. There's also the listing shortage, which is the other one that gets reported. We speak of housing shortage, that okay, then you have the listings, like the listings that are on market. And there is a shortage to that relative to demand. And those are kind of arguments for, okay, prices are not going to decline. But then if I look at the total housing units and total population in given markets, in some markets, they're increasing and shortage is reducing, actually. So which one do you think is the most relevant? That's a question I don't know. I would think as if like for the broad market, it ought to be the broad US Census total housing units, total population. It should be the relevant one. But I do see like the one that you have here in terms of like the gap in under construction that we currently have, and as well as some of the listings available for sale listings versus the market demand for that.
Right. So it sounds like a couple of questions there. I think the first question would be, why do we need to build so many homes? I mean, it's kind of crazy. For the number of households we have, every year we have obsolescence. Either homes are falling into disrepair, or people are just moving, migration. You see people moving out of some areas, moving into some new areas. Many reasons there are many reasons behind why we need to build this many homes. But again, this is assuming, and you did also mention the issue of how many households were forming, or when you look at it from a per household basis, it is a little different. But again, we are having a lot of immigration just as one factor. So again, we're needing more housing than ever. Airbnb and other places like Vrbo short-term rentals are eating in. People are demanding 2 or even 3 houses because they work from home, and those who can afford it do. And people in general, even people who can only afford one home, they want a nicer home. They're demanding more home. So I think all these factors might tend to suggest that this could be an underestimate. And look at migration. I mean, people are moving very quickly, very quickly. The Midwest has been traditionally called the Rust Belt, and we are still in general losing some population. So what this means is that as people move to new places, if everybody stayed in place, you would still need new housing from time to time, because again, homes fall into disrepair, they become undesirable, etc. This immigration and seeing a lot of migration is just, I think, accentuating the problem.
But okay, but still, I kind of want to go to like the previous question, like with commercial versus residential. So if we, like kind of in 2006, okay, the general intuition is with the excessive lending, the housing market is more overvalued than commercial, and commercial declined not super much, right? But also commercial investors, they tend to quote that it's inherently resistant to housing crashes, which I I would doubt. That sounds unlikely to me, right? I mean, I don't think it works like that. And so one thing that I've been wondering is now with the rent growth in some markets of 20% plus, now that's insane, right? On an annualized
Yeah.
basis. Could it be that commercial is perhaps more overvalued in those markets than residential?
Yeah, I see. I see.
But
Well,
on
I'd
the
like to
other
see some
hand,
comparisons of
I'm
how
sorry,
rent has
George, but
increased.
on the other, I'm sorry to interrupt,
Oh,
but on
sorry, go
the
ahead.
other hand, I'm not sure if that rent, that 20% rent growth, what created it? Because okay, it's inflation, but is it because the of mortgage affordability supposedly created it, right? Because okay, then multifamily landlords could raise the rents 20% because just it's even less affordable to afford to buy a house now. In the both interest rates and prices up, and so mortgage affordability significantly crashing. So if that's the case, then okay, maybe housing market is still equally overvalued as commercial, but it's just some intuition to me. It's like with the growth that I saw in that and some of the, even sponsor project returns and so forth, it could go the other way this time. I don't know, right? It's an interesting question.
Yeah, fabulous. And I'd like to see some comparisons. I haven't seen any yet between rent increases in multifamily versus single family. I believe the rent's going up everywhere.
Hmm.
I mean, I would say that what would concern me is that if residential values do come down, or rents come down, certainly people are not going to pay more to live in an apartment than they will in a home. And so those single family homes, they're going to put really a hard upper bound on where rent can be. So if those start to come back down, certainly the spread, will have to be maintained to some. But again, yeah, that's interesting, and I would say provocative. Could it be that that commercial is more overvalued this time? Hard to say. They're always the black swan events. Who would have known how overvalued office space was going to be once everybody got kicked out of the office?
Right. Yeah, exactly. Right. Okay. So we have a question from Asha Brown. So if you wanna speak up? I'm not sure if. Yeah.
Hi, sorry about that.
No,
Yes, how are you doing? This is my first time here. And so I found this class, I found this information to be extremely informative and I'm really appreciating it. So thank you to the both of you. So I have a question, George. I am a budding developer and I have some land and contract and I just wanted to hear your thoughts on affordable housing compared to in this market and where we're going. I'm hearing a lot of developers and builders say that the affordable housing is the way to go, but I don't know if they're leaning too hard on mainstream media crisis, etc. And I'm in the process of making some decisions on what I'm going to do with this lot. So
Right.
I just want to know, what are your thoughts there? And yeah, that's it.
Right. Well, first of all, thanks you for coming today, and thank you for the question. I think you have to define what we mean by affordable. So when people talk about affordable housing in the media, I believe what they're generally talking about is something that is subsidized. Now there's a couple different
Yes, that's what I
subsidies.
mean. Yeah, that's
Yeah,
what I mean. Subsidized
exactly. A
housing.
couple different programs. Now, as I understand, there's no more building subsidies for Section 8. That's gone. Okay. We still have the subsidies to individuals for Section 8. The main thing is LIHTC. I know there's some other programs too. Many people that are much more well-versed on this. And if you're able to make a go of things like that, I know it's very hard to go for those tax credits, depending on the state. I know in Michigan, if I'm not mistaken, I think there's more money spent trying to go after those development credits than actually getting them, which tells me that there's a few very, very entrenched developers that are capable of getting them. And of course, your state may be vastly different than that. And it's very hard. It's a lot easier to go after the redevelopment credits, which are at a much lower rate. But again, they're much easier to get, much easier. There's a lot of rules. You have to do a lot of thinking to do that. But again, I would say that at this point, again, the developers can pick and choose the most lucrative project. Generally, that means something more towards the luxury spectrum. I don't know what your market is like or what your sub-market is like, whether it supports that well or not. But again, I do see when it comes to building that it's very much the case that it really makes sense, I think, generally to go after the most expensive. But again, it's a very difficult niche. If you understand the affordable housing and you know have to go to those credits, or you get the right partners, whatever it takes, it's very interesting. You can get a lot of your construction funded and hopefully help a lot of people along the way. If you don't mind, if I could just maybe pivot a little bit, from affordable housing in the narrower sense, as we were talking and as the press refers to it, but I would say more affordable housing. I like what I call the warm markets, areas that are affordable, because I think people can still afford to move there. At some point, we have to decide, can everybody move to these hottest markets? Sure. If the wages go up in those areas, you could have potentially more markets that look like San Francisco, but very, very questionable whether that's the case. And I'm moving myself towards more affordable markets. By the way, and again, to preface, I'm not by any means an expert in affordable housing. I just purchased an apartment, in fact, yesterday, where we have some people on assistance. So not a true affordable housing situation. What I would say, maybe not as defined in the dictionary sense, but affordable housing in terms of where the rents are at. So something I definitely have my eyes on, but definitely like to stay in touch. And again, everybody, we need places for everybody to live, and we can't just keep building the expensive stuff. So we need some solutions. Again, I would try to focus on getting the approval process to be a little easier, maybe a little less NIMBYism. Who knows? Maybe these accessory dwelling units that they're building in California will help to alleviate, but we definitely need some fresh solutions. So thank you for the question.
Thank you very much.
So, and yeah, we're over time, but just like a couple of questions before we wrap up, George, and thanks for being generous actually with your time there. So because you mentioned like differential troubles for like, in commercial, if we stick to commercial, let's say multifamily ABC costs. So, they could experience like different, relative trouble, let's say. And so which one you think could be the outperformer on a risk adjusted basis is a question I don't have an answer to in a recession between A, B, and C, because I've heard of some of the arguments for class C outperforming, but I'm not sure. Mm-hmm.
I'm going to say from all that I'm seeing, it could be your B class. It's hard
Right.
with A class. I mean, unless you're the developer. I
Right.
mean, you really have no place to go but down.
Mm-hmm.
I understand why people buy these properties. I mean, they're doing well, or they have just different return requirements. C, I don't think it's going to be C, but again, I would look for what I would say niches, submarkets. You can find some niches in C. So I'm still operating in C class, not because I expect in general for it to outperform, but because I'm getting some good deals. I'm getting good deals in terms of interest rate with seller financing, getting good deals in terms of the number of years of interest only I can get, and getting great deals in terms of not having to bridge out. So I see a lot of players playing the really big game, and they're doing very well at that. I do have some larger acquisitions, but again, I would say, I think maybe B class might be the way to go. But again, look for the niches. If you can still operate in the C space, turn it into a B, you may get the best of both worlds, but you're not going to do that, I think, very easily, not easily with 200 or 300 units. This is going to be the smaller, less than 100 units.
Mm-hmm. Right. And so do you think actually in the current market, like seller financing could become, in the higher interest rate environment, seller financing could become more popular as it's sort
Absolutely.
of, quite negotiable on the interest rate?
Yes.
Mm-hmm.
Yeah. And we've been fighting for that. I mean, just in the deal that I just very recently closed yesterday, we were fighting to have it assumable. And, if it comes to it, maybe 2 or 3 years down the road, we have the right buyer and we can convince the seller that we have the right buyer, and we get approval to have that assumed. That's very lucrative. If rates were at, say, 7%, you have a 5% assumable mortgage, That's huge. That's dollars in your pocket. So again, I think you really have to look at it like maybe like a game theory or something. I mean, just look at all your potential exit avenues and just consider the fact that, well, I want to say that people aren't fools, but I think that in a rising market like we've had, there may be a lot of fools in the market. Those fools are going to get swept away. People who are getting the wrong financing, who are in the wrong market, the wrong class of property, who don't know how to manage it, could easily find themselves in a lot of problems. Bridge loans are going to become a problem. I mean, there will be opportunities out there. Question is whether enough investors to snatch them. So get a good relationship with your lenders. And if you're top of mind, when they see somebody that's on the verge of default, who knows, they may call you up and say, hey, Fred over here can't pay the mortgage. He needs the bridge out of this thing. If you can find a way to make it work, hey, you may get it at a haircut. We'll see.
Right. Yeah. So we may get basically a lot of outperformance or kind of alpha even on the financing side with certain operators operating in the correct asset class, being able to get, and market being able to get more seller financing. So that's an interesting perspective. And so with regards to labor force participation that you mentioned, and sort of the, I guess, NBR not declaring a recession yet. Do you have a sense as to what's going to ultimately tip, I guess, the table, so to say, and make them declare a recession? I mean, because it's definitely, it seems to be predominantly in the employment space.
Right.
But what do you think could tip those numbers so that they whenever they ultimately perhaps do declare it?
Well, you said in the broadest sense, it's going to be labor. So the question is what's going to cause, the scale to tip? And real interesting recent quote from, sorry, it's slipping my mind, from the Tesla founder. He says, thank you. That as soon as the sort of the economy hits the fan, all this laying back, all this quiet quitting, all these people who feel like I can stay home, I don't need to work. Oh, the people are going to realize very soon that you're going to need to participate in the economy because things are costing more, right? Whatever you thought was decent savings is not.
So may need to work harder in a recession, basically. Sounds like.
Yeah, absolutely.
Okay, sure. Right. That's a good point. And so what did you mean under, like, when you said like no crash within 5 years? Because
what I'm saying is that I don't think that
ever, or does it mean you could expect a delayed crash further out?
Well, okay, so define crash. We're not going to see something like 2000 thing because we saw decline significantly. I don't think we're going to see half of that, like 1990s, which, by the way, you've done a great job of beating the drum. We're not just going to look at the last recession. A lot of people, I think, are fighting the last battle. That's not the way to win the war. So you have to look at some more milder recessions too. 1990 home prices declined relatively mildly. So I think you've been in your work leaning towards a more 1990s style of what might happen versus 2008. And I would say the same thing. I don't think that we're not going to see 20, 30, 40% declines in home prices. We can't. We have more equity and we have too little supply. So bad things can happen. And I think that poor operators are going to get swept out. But first question to answer is, what is the climate going to be like? And then we're still going to see that some people are going to drop debt from heat prostration. But I think that, we're not seeing that, the temperatures are not rising that fast here in real estate.
Right. Okay. That's great. Well, thanks. I think we covered quite a bit of ground. So a lot of amazing charts, some of them that you've put together yourself, actually, and thank you for that. So what's of great value to our audience and myself. So with that, like, what is the best way for people to reach to you, George? And if there's anything you want to share with our audience, before we wrap up, that now is the time.
All right. Best way to reach me is george@horizonmultifamily.com. Just send me an email directly to george@horizonmultifamily.com. Happy to work with anybody, whether you're new or more experienced. Love to talk real estate, whether you're active or passive. So please send me an email. I also have a podcast, The Foundry, if you want to learn more about me, and a YouTube channel. But again, if you want to reach out directly to me, send me an email.
Great. Thank you so much. This was awesome. Thanks, guys, for
All right.
joining. Have a
Thank
nice-
you so much for the opportunity, Stefan. Love your work. And it's been a great honor to be here today.
Likewise, George. Honor is mine. Thank you.